You know how sometimes in life, everything just goes your way, everything's perfect? No. But imagine for a second, you find yourself a steady relationship, you're super happy, you start to finally make some money. But then 2020 happens and life, so you lose your job, and with that, your money, and of course with that, your perfectly stable relationship as well, and everything you value that's gold just turns to whatever this is. Well, that's kind of what happened to Robinhood this year. Press F to pay respects, and let's talk about it. Hi, my name is Andrei Jikh. Hope you're staying safe, hope you're doing well, and my, Robinhood just can't catch a break this year. Even though they had a lot of great news, like 13 million new customers signed up this year alone, they're also now roughly valued at $11.2 billion. All great news, except they had a lot of bad news this year too, like back in March when the outages happened and people weren't allowed to trade for several hours. Of course, upset a lot of people, rightfully so. They were also supposed to expand to the UK markets in Q1 of 2020, which did not happen. They also had the unfortunate incident with the 20-year-old kid who was trading options, and now we have this investigation. So this is brand new. Let me tell you exactly what's going on and how this will affect you and I going forward. But first, I want to put it out there that I'm not sponsored by Robinhood. I don't have access to special features early on. I don't get treated any differently than you, and I've just been using the app for many years now, and I wanted to make this video to keep you in the loop. So here's what's going on. According to Wall Street Journal, Robinhood Markets Inc. faces a civil fraud investigation over its early failure to fully disclose its practice of selling clients' orders to high-speed trading firms. This makes me cross-eyed just reading that, so let me explain in plain old English exactly what that means. Now, when Robinhood launched in 2013, it changed the game completely for how young people, including myself at the time, invested. That's because before that point, you couldn't buy and sell stocks for free. It was unheard of. And so when this brand new app called Robinhood came out, everybody was left wondering, how were they actually making their money? And they published a page on their website that was called How We Make Money, which of course nobody ever read because nobody reads the terms and conditions because ain't nobody got time for that. But inside the page, they described the two methods that they make their money. The first method was actually from the interest that they collected from the money that we deposited into our accounts. The second way that they made their money is from the fees from the margin trading accounts. Now, if you're unfamiliar with what margin trading is, it's basically buying and selling stocks with money that isn't yours. It's money that you borrowed, which is considered collateralized, which means if you lose that money, not only do you lose that borrowed money, but you also have to sell your stocks and give up the cash in order to pay for those losses. So it's a very risky strategy, and if you win, then you win big, but if you lose big as well. So those are the two main ways that they told us about before, which was just collecting interest and margin accounts. But it turns out that there was also a third way, and that third way is called payment for order flow. It's really complicated, so I'll try to simplify what it means. Payment for order flow is the money that Robinhood receives, not from people like you and I because it's free to buy and sell stocks on Robinhood and it's a free app, but instead the money that it receives from the market makers for routing our trades through them. Which I also realize does not help you at all, and it's probably your first time hearing the words market makers and trade routing. So here's exactly what it means. It's really complicated, so see if you can follow along. Robinhood does not execute its own trades like some brokerages would. Instead, it outsources that process to a third-party company, which could be just a really wealthy individual or a huge corporation. And you can think of these guys as sort of like the wholesalers or the middlemen of the stock market. They are between themselves, Robinhood the brokerage, and you and I. So what Robinhood actually does is it pairs up you and I, the buyer with the seller. And if I wanted to buy a stock from you and you wanted to sell it, the app would find you and I and pair us up and say, hey, you guys should meet. But it's at that point, still, you and I don't exchange anything. This is where the market makers step in. They're the ones that hold the stock that you and I want to buy. So their whole goal is to buy a bunch of stock and get rid of it as quickly as possible to make that profit. So what you and I see on the brokerage level as far as what these prices are is not the exact same one that these market makers purchased at, and what we see is maybe a fraction of a penny more than what they purchased at. So for example, Robinhood might show us a $100 stock that you and I might want to buy. then the market maker has to fulfill the order from the client. Now the client in this case is Robinhood, except the market maker didn't buy that stock for $100. Instead, they bought it for $99.9999, so they get to make a profit of a fraction of a cent, and that's how they make their money. And they do this on both ends, for both the buyer and the seller. Now the reason these middlemen are so important is because if you ever wondered, how's the stock market so fast? Like, I could buy and sell stocks without ever having to meet you or talk to you. It just works like magic. I press a button and I get money. That's because of these market makers. Every stock that you want to buy and sell is immediately available for us to do so, and that's because of these market makers. Without them, you and I would not be able to trade instantaneously. If you wanted to buy 10 shares of Apple, you would have to wait until there was someone on the opposite side wanting to sell you 10 shares of Apple, which could obviously take a while. Welcome to the eBay business model. The second reason they're really important is because they take on all the risk. Think about it. If you ordered millions of shares worth and you were counting on the brokerages to send an order, and if they don't do it quick enough and the stock price falls, then all that inventory of millions of dollars is going to be worth a lot less. And the bid and ask spread of just fractions of a penny isn't going to make much of a difference for you. So if you thought your profit margins were razor thin, meet the market maker. The third reason that market makers are so important is because they compete with one another to give us the most competitive price possible, and they must also follow the SEC guidelines not to take advantage of investors. And it's argued that these guys give us a very accurate reflection of what stock prices should actually be, and without them, we'd see a lot more volatility, less consistency, we'd wait a lot longer, and we'd probably pay more in price as well. Now here's where Robinhood steps in. Payment for order flow on the legality scale is actually very legal. It's totally fine. There's nothing wrong with it. And in 2018, Robinhood made half of its profits from these market makers in the form of rebates and sort of kickbacks, if you want to think about them like that. But in 2020, here's how many millions of dollars they made. $126 million from Citadel Securities, $75 million from Susquehanna, $37 million from Wolverine, $20 million from Virtu, $9.7 from Two Sigma, and $1.6 million from Morgan Stanley. If you're still shaking your head like,
no, these front runners, I don't trust them.
Well, then in that case, there's still actually nothing wrong with the payments that they took. What is wrong is the fact that they didn't disclose to us that that's how they were making money before we placed our trades, which can create a potential conflict of interest. But if you're still not sure about how to feel about all this, I'm going to leave a link in the description below the video to the SEC report that addresses a part of this issue. But since I know you're not going to read it, I'll just summarize it. Basically what it says is that there's pros and cons to all of this, but these high frequency trading technologies are just going to be a part of our future. But as long as we are transparent, open, and honest about this procedure, then everything will be fine. So ultimately, how does this affect you and I as investors and users of the app? It kind of doesn't affect us much, especially if you're a long-term investor, because overpaying an eighth of a penny for a stock isn't really going to make or break the difference in your retirement long-term. But maybe if you're a day trader and you buy hundreds or thousands of stocks at a time, in which case maybe it might make a difference. But in that case, you probably shouldn't be using Robinhood in the first place, because there's far more sophisticated options for that. But if you're still concerned, then there's a really simple, elegant solution for this, which is to use a limit order. So if you do that, just place a limit order for what you think the stock is worth and the problem's solved. And here's how you can do that. Just go to the trade section, hit buy, and then go to the upper right-hand corner right here where it says dollars, and under conditional orders, you can click on limit order right here, and then you can see the market price move up and down ever so slightly. Now this price right here is not the actual price that the market maker bought the stock for. So now that you know that, if you're like, I don't want to pay a fraction of a penny more for this stock. So let's say you wanted to pay, I don't know, $122 for Apple, right? You can hit continue, either market hours, it doesn't matter the next section, 1 p.m. or until December 3rd, doesn't matter. If the market makers don't fulfill my order by December 3rd in that case, then my order's canceled. So this is just a really great solution and workaround if you don't want to pay a fraction of a penny more, but you should always get into the habit of buying your stocks through limit orders anyway. Now, if you're still concerned that Robinhood is involved in some illegal front running, which is where they buy a stock with access to insider trading information, driving the stock higher, higher so they can fill an order and sell it back to us at a higher price to make some money, then that would be very illegal, and there's no evidence to suggest that they're part of anything like that, but that's why we have the SEC. My guess is they'll be just fine, and if they do settle on $10 million or whatever it'll be, that's a small price to pay for being a bit more careful of disclosing this information to investors. But if you're still unhappy, then hold on for a while longer, because we've got DeFi coming in the future, which is decentralized finance built on the Ethereum blockchain. And this will allow us to buy and sell stocks without a central entity. Super excited about it. Not the point of this video, but definitely give it an Oogle on Google. If you haven't already done so, go ahead and grab your free stock from Robinhood while they still have money, and then you can get your second free stock from Webull. If you fund that account $100, that second free stock could be valued up to $1,600. You can also follow me on Instagram. I post from time to time. Join my free Discord group. Love you. Thank you so much for watching the video. Stay healthy, stay safe, and I will see you back here on Monday and Friday, and maybe sometimes a Wednesday too. Love you. Bye-bye.